Welcome to the Rizz podcast. I'm thrilled to have Jan Brzeski here today. Jan, you're the managing partner of Sage Credit Investment Partners. You recently just launched this new company. Why don't we start off by telling everybody a little bit about your new company and your new program?
Absolutely. Thank you for having me, Dana. And it's nice to be in touch with you again after these years. I was on the East Coast for about a year and a half in North Carolina, and that's when I started our new business, Sage Credit Investment Partners. And after thinking of all the different niches to target in real estate investment and real estate lending, I came to the conclusion that doing what I've been doing the last 15 years was going to be most satisfying for me. So, kind of starting again what I did with my last business, Rizz Capital, which is still going strong, and I'm not involved in management, but they're sizable and growing. And we finance small residential projects. So 1 to 10 unit projects typically, which would be bridge, renovation, construction loans. We don't finance owner occupants. We finance real estate investors and developers who are typically adding units to a project that they purchased, or maybe renovating and repositioning a project. It used to be that there were a lot of single family projects where someone was just sort of building a larger single family home and selling it. But that's actually changing in ways that we could talk about if you want to dive into it. Where I see the opportunity today is a little different. Still the same general space, but the needs of the market are a little different today.
So, for any mortgage brokers or capital advisors who might be listening, can you go a little bit deeper into telling people what your lending program is, your terms, your rates, what kind of deals maybe they should be sending you?
Absolutely. So we are both a non-bank lender and also a fund manager for real estate credit investors, people that want to get steady yield. And really the rates that we charge are dictated by what our investors require in terms of returns. And in real estate private credit generally, we need to be able to deliver at least a 9% return today, in my view, to be competitive. So we have to charge um, a little bit above that. We try to charge the lowest rate that we can to meet the needs of our investors. And we also try to pick the borrowers that we most want to work with, since we are not traditional hard money charging 12% and a bunch of points. We're charging more like in the nines, maybe 10%, and maybe a point to 2 points depending on exactly what the project is. um, we do a lot of construction loans, but we can't do exclusively construction loans. We focus on loans of 3.5 million and below, and that's because the balance sheet that we have for my new company is still pretty small, and so we can't do really large loans. So we're just doing smaller loans up to 3.5 million, maybe stretching up to 4 million or so.
And in what regions do you want to see deals?
Well, absolutely. We're in North Carolina, in the Raleigh-Durham areas where our office is located. And we have a few people here in Southern California. I moved back here about 4 or 5 months ago, and I'm looking for good borrowers that want a high service lender that can sort of show up and see the property on short notice. I'll give you an example. We're making a loan in Pasadena, and the person that came to us has a partner who's doing more projects, and the partner wanted to meet us, and he's in the Inland Empire. And our way of wanting to pursue that was to say, hey, let us come out and see what you're doing, right? Let us drive out and see you and meet you and see your projects in where you are in the Inland Empire, which which I think is a little different from how a lot of these lenders in our competitive space do things. They tend to be more over the computer, meeting via Zoom. Nothing against Zoom. Thank you for Zoom for letting us do this interview. But I like seeing property in person, and I like meeting people in person and building relationships. So that's um, that's what we do. And so Southern California and North Carolina would be our two top regions. We have made loans in maybe 4 or 5 other states, but that tends to be very relationship driven. If we have a borrower that we feel really high conviction that they're good and we want to build a relationship with them, we've done some stuff in other places. And I would say places that I see the merit of what's driving those markets. And so, we'll do a loan in those markets that we think are good markets.
I know that you've seen a lot of good deals and you've seen a lot of bad deals. And when you're looking at a new potential loan, you go out to the property and you're meeting the borrower. What is something that you've learned that you need to look for?
Well, I've done more than 1,800 loans, and actually written some articles which I haven't published yet about lessons learned from 1,800 loans. Because you're right, we've made a lot of really good loans, and we made a few loans that I wish we hadn't made. So I'll just tell you how we evaluate loans today, which reflects everything I've learned over my career. First and foremost is to sit down with the borrower, preferably in person, and sit across the table from them and get to know them. And then we ask ourselves, is this someone we want to have in our life for the next X number of years? Because we're never making a loan thinking of just one loan. We're thinking of the relationship and hopefully multiple loans, and hopefully getting referrals from that borrower, which we'll get into later because I know that our focus for this podcast is marketing. And referrals are super important. Repeat business is super important. So that is far and away the first question is, do we want to have this person in our life? Are they going to treat our team? Are they going to appreciate what our team does? If our team really puts themselves out to make sure that everything is as good as it can possibly be, that we're doing the best job we possibly can as a lender, does the borrower understand that that was a big effort, and are they willing to give us some credit for that and treat us, with respect in return, or do they just take it for granted? Because if they take it for granted, like any relationship, it's not a good relationship. It's not a two-way relationship. So it has to be a two-way street. Of course, does the borrower have a good track record? Are they skilled at creating value through whatever their business plan is? And hopefully their business plan for the project we're going to lend on is something that they've proven that they can do in some way, or they at least have very relevant experience. Even if it's a little new, their experience is relevant. So it's sort of borrower first, borrower personality, character, fit, borrower's track record, and then we get into the project. Because if the first two are good, the third one is usually good too. They're not going to pursue a project which is sort of like a Hail Mary pass if they're the type of borrower that we like to deal with. They're more likely to say, hey, I found a niche. It works. I'm so fortunate. I'm gonna work this niche as far as I can, as long as I can, stay in my lane and make money doing that for as long as I can. That's how we think of things too. Exactly, which is, we're so lucky to be in a business that works. Why would we want to spread out and do this or that when we have something that works right now?
So just on the borrower side of the business, I mean, you're in a very, very crowded space. How are you planning on differentiating your company and what you're doing from people who are your competitors?
Absolutely. That you're right. Coming in and starting a new business a year ago in this space was pretty different than when I started the last business almost 20 years ago, and I started the first fund doing these types of loans about 15 years ago. And there are some extremely capable companies in the space, including my former company, Arixa, which it remains, the management team is phenomenal. They absolutely get it, and yet there's so many borrowers in our industry, right? Especially since we focus on these small projects, where a lot of the projects we're financing now are taking advantage in California, are taking advantage of SB9, which allows people to build multiple units on a lot. These are small projects, and so there's really hundreds, if not thousands, of good borrowers to be had. So the way that we differentiate it, to answer your question, Dana, is if we get fortunate enough to get an opportunity to meet a borrower, which, by the way, we do not lend to Arixa clients, where, we don't want to be in a conflict with them, and I have an agreement with them as well that precludes that for now. And even after that agreement is expired, I'm not going to be eager to try to compete directly with my old business. I still own a portion of that business as a minority investor passively, but it's there's no other company that I know of that can put the founder and chief investment officer in front of the borrower in person in 24 hours at the property. And the founder's done 3.5 billion or 4 billion of loans. That's in our industry, that doesn't exist, because the people who are CIOs or are the CEOs and decision makers of these other larger companies, they're doing so many loans now that they can't put the top person in front of that borrower in 24 or 48 hours, maybe not even in three weeks, because it's just the law of large numbers is they can't meet every borrower. They have to have other people meeting the borrowers, and then they have to decide what to do. So we're in a fortunate position at the moment of me being very focused on every single loan. And I'm the biggest investor in our funds as well. So, I really care about the quality of these loans. So that's our differentiation is, we're a high service company. We're going to take great care of our borrowers, just like some of the other well-run companies in this business. But, no offense to anybody else, but they can't compete with what I got, because I can go out to a property and say this loan is approved. It's not going to investment committee, tomorrow, and I think it's going to be approved. It's approved now. So that's certainty of execution, and very few other companies have that. And frankly, it's good that they don't have it, because that when you get to scale, you can't run like that, right? You can't have a process that's just one arbitrary person making a decision. But when you're at our scale, you can, and it makes sense to do that, and that's what we're taking advantage of that. And of course, that's to balance out what the other companies have, which I don't have, which is tremendous scale, tremendous brand equity. Having done business with hundreds of borrowers, having this enormous roster of amazing borrowers and brokers that have transacted with the company. So, we're small. We're gonna be a lot smaller than everybody else for a long, long time, and I welcome that, because it allows us to make good loans and have great relationships with the borrowers that we do work with, which is a relative handful of borrowers compared to what the other companies are doing.
You taught me a lot about marketing and business development, working for you. And there's one story that I have been recently repeating quite a bit. You had a relationship with Jerry Ducott at Lone Oak. And I think I said to you at one point, like, what are you doing, Jan? He's your competitor. You're competing after the same loans. And you said to me, not at all, Dana. We have this relationship where we refer business, we ask questions to each other, we go out to lunch with each other. And it opened my eyes. I think that it's so interesting because people look at their competitors oftentimes as a threat, where you look at a lot of your competitors as like, hey, I want to have lunch with them. And that's something that I learned from you.
Well, I'm so happy that you brought that up. And I had breakfast with Jerry not long ago, and I continue to really appreciate him and what Lone Oak has built. First of all, Jerry was kind enough to meet with me when I first started this fund, even though his fund was much, much bigger. And I modeled what I wanted to do as a non-bank lender in some ways after Jerry and his company. Now, we did take a different approach in that we're doing loans with construction draws typically, and they don't do that kind of loan. They only do bridge loans. They don't do renovation and construction loans that have multiple draws. So that did create a nice differentiation where they can refer someone to me, and it's no loss to them, and it's a great benefit to me. But I think more generally, they created this model, and I just followed it. And I would say, and a perfect example is they used to do an event once a year at the Bel Air Bay Club, which you've been to, and they'd invite everybody. They'd invite, the brokers, borrowers, their competitors, anybody and everybody that wanted to come, other lenders. And they didn't worry for a minute about it. And I think they've done just fine. They have $1.3 billion of loan portfolio, I believe, and a very good track record. And so it's there's a lot of ways of doing business, and Jerry developed one of the nicer ways. And I would also credit my former boss, Sam Freshman, who my first boss in real estate, who had a similar approach, which was take a phone call from anybody, try to see if he can help them move things forward. If it's not something he can do, he'd maybe refer it to somebody else. And there's room for, there's room for friendly competition in this industry. There's room for everybody who's good at this to make money doing it. And I still love that approach, and it allows me to have really good relationships and good friendships in the industry. So I'm glad that that worked for you. And I do think it's sort of it's a bigger picture approach, which pays dividends, even if it doesn't lead to the biggest net worth. Maybe it leads to the best. And when I'm on my deathbed, I want to have good memories about all the people that I've worked with, and that's high on my list of goals, is to have good relationships in the industry. And I would say Jerry and James over at Lone Oak have done that too.
So, what do you have coming down the pipeline as far as an event that you're thinking about? Because I know when it comes to marketing, that has been one area that, has helped you as a company. So, do you want to talk a little bit about kind of what people can expect to see coming down in the near future?
Sure. I love real estate events and I love in-person events. I feel like there's no better way to meet potential borrowers and sometimes investors, but more likely borrowers, than real estate events. And so we did do an event at UCLA for about 15 years running before COVID. And after COVID, we did not restart that event for a variety of reasons. But it became an important way that we built our brand, and I also built up myself as a member of the real estate community that could be on stage with people that are managing multi-billion-dollar funds and portfolios. And it was just very good for us in a lot of ways. And the people that spoke at those events were really taking a little bit of a chance by agreeing to do that, because it was an event that we were producing. And I appreciate all of those speakers that participated over the years. Um, I'm still deciding which events to do next, but I want to do events that are related to what we're planning to do as a business. And the way I think about events is, who do I want to meet? And then let's produce an event that's valuable for those people. Let's as valuable as possible. So one area that I think will produce loans for us in the years to come is rebuilding in the fire zones of Altadena and Pacific Palisades. And so I've begun my own podcast called Rebuilding LA After the Fires, where I'm interviewing people that have insight into what is going to be involved in that, what's happening in the market, in those markets right now, who's buying lots, what are they planning to build, and what are the obstacles from the city or infrastructure or whatever else. The fire rebuilding is an incredibly complex situation, and I wanted to learn myself about what's going to happen, how is this going to roll out. And so interviewing the people on the podcast is a way for me to learn from them. And we may well do one or two events around that using some of the same speakers as our panelists. And if we did, I'd want to do it, look close to each of the fire zones. So maybe one in Pasadena, maybe one on the west side of LA. But we haven't made a final decision yet, because producing a live event is an enormous undertaking, and still doing research. And the way to do research is with this podcast and meeting people and sort of filling in my own blanks first. Another thing that's driving our business now, I mentioned SB 9. There's new state laws in California that allow for building more units per lot. And it's really interesting. And there's a lot of smaller developers that are starting to take advantage of that. And I'd like to do an event around that to understand, what's really happening. How is this getting deployed and executed in different cities? And are cities blocking it and trying to block it, or are they welcoming it? And what's the experience on the ground in, LA, Santa Monica, Pasadena, or Northern California for that matter? And there's other topics too that I personally am very interested in a lot of things and want to learn myself and keep learning. And The one other topic that is always interesting to me is more on the investor side. What can investors expect from real estate private credit? What can they realistically expect? And what are some of the hidden opportunities and challenges and maybe risks that people aren't as aware of in terms of ways of structuring real estate private credit funds? It's also the case that if there's something in the business that really needs attention, and we need to hire someone for a position right away, then that takes precedence over everything else. And I tend to sort of put the events a little further out on the calendar if I have things that are occupying all my time right now. Apologies, that was a long answer, and I'm not giving you time to ask your follow-up questions.
You did post a job, and there is a position out there, and maybe this could be a good time for you to tell everybody about this opportunity that you have.
Well, the job that we posted is manager of lending operations, which is it's really working with our loan portfolio and our borrowers in the areas of servicing loans, which means collecting the interest and keeping track of how much interest is owed and letting our borrowers know, and kind of that whole side, as well as closing, which is very important because many of our loans are to borrowers who are buying a property and it has to close on a particular date, and we need to be able to perform. That's our big part of our brand is perform on time for closings that are time sensitive. And then also construction loan administration, um, because many of our loans have construction draws. That makes the job a little more complex to manage these loans because the loan balance is changing over time, and we need to go through our checklist before we release additional funds on a given loan. So all of these things are kind of more in the background of our business, but very important. And since we're becoming more active in California, we're looking for someone to oversee all of that that's based here in LA.
Well, hopefully somebody who's listening might be interested in this position, and hopefully you'll get a couple of resumes that come through.
That'd be great. Thank you.
So you also mentioned the fires, and I want to touch that topic for a minute. So if you're going to do or plan on doing some loans in the Palisades or Altadena, when a borrower does a loan with you, how are you going to manage the loan if nobody knows how long a project's going to take? Because there's so many unknowns at this point.
Yes, that is a good question. And how can anybody invest in the fire zones today with so much uncertainty, right? And yet, who's going to buy lots if not builders and developers? You might have some owner occupants buying some lots, but not too many, right? Because I don't think an owner occupant who's never lived in Altadena is likely to buy a lot thinking, okay, I'm going to build my dream house in Altadena and move into it right now because, it's a fire zone and it's going to look like a fire zone and a construction zone for a lot of years. So this is what makes it so complicated and challenging to rebuild. So your question was, how do you know what the loan maturity is? And I think we take our best guess. We typically would do maybe a 1-year loan for someone that's needing a bridge loan until they get their permits done. And we are doing some bridge loans on lots in Altadena today as a test case. The construction loans are typically 12 to 18 months. And I think in the case of the fire zones, you'd probably want to make sure that you have at least 18 months, if not 24 months, for them to do their project and sell it, if assuming that they're going to sell it. It's also possible that people would rent out what the units that they build. If they build, 4 units on a lot or something, they could rent it out and then hold it as an investment as well. The bigger question is, of all the things to do, why invest in the fire zones now when there's so much uncertainty? And I think the answer for us is this is part of our community. It needs to be rebuilt, right? This is a scar that needs to be sort of healed. And those of us who have the ability to help with the rebuild through our work experience and resources should be leaning into it in whatever way we can, in my view. And also the people who get in early, namely our borrowers who are among the first people to buy lots and build properties, I do think they'll have a great learning advantage because they will know sooner what is really happening in the Palisades. What are the real challenges? What types of homes are people going to buy there or not? And um, I'm not sure they'll make money on their first or second investments, but I do think that they're more likely to be able to do 30 or 40 if they start early versus if you wait a year until there's less uncertainty, or 2 years. I think that there's going to be a lot of people who have gained the critical experience of knowing what works and what doesn't. And so there's always an advantage to going early. You don't want to go so early that it's a disaster, right? But you want to be able to go early enough that you can get the critical learning done and be able to, be active in those fire zones. I hope to be active in both fire zones for the next 10 years as a lender.
That sounds like a smart place to be, and I know that's the direction of your company. So we talked about the borrower side. Let's talk now for a moment about the investor side, because again, it is such a hard time right now to raise money. How do you plan about tackling raising money for your fund and going about finding investors?
Right. It is a hard time to raise money, and people that want to invest in private credit have a lot of options, including a lot of brand names that are raising their own private credit funds and offering similar returns, like
How can you compete with
9%.
an institutional player like Ares?
So, so I always look at it on a very local, sort of personal basis, is in that who am I meeting, and will they are they interested in learning more about what we're doing if they're a potential investor? And we have kind of two types of investors, or maybe even three. One is people that might invest into our fund, which I launched about a year ago. Another is people that might want to invest in individual loans. So what we're doing today is we're funding loans through our fund, but then we have a couple of investors that buy participations in loans after the fact. So those tend to be bigger investors, and they may want to choose which loans to invest in, and they have the expertise to decide specifically which loans they like and don't like as much. So that's a second type. And then the third type would be larger institutional capital that wants to do a joint venture. This would probably be more after my agreement with Arixa runs its course, probably late next year. There could be joint ventures to do or things like that, institutional capital, which I've done before. So I think my approach, I know you're interested in marketing, and my approach to raising capital is to be out there doing things, talking to people, and I always like to ask a question. If they seem like they might be interested, I'll ask them, would you like to learn more about our funds and more about our kind of our strategy? And if they say yes, we have some really nice materials we put together that show people what we're doing now, what loans have we done to date, what are the returns to date, what are the criteria of the fund. So we just send it out and we put them into a kind of a we just plan on following up with them, every quarter, and eventually some of them might choose to become investors, and some of them might not. But I do have a great track record of having done 1,800 loans and very few loan losses, and one of the better track records in our industry. So that's helpful. But I think the key is really, it's funny. I think about one thing I think about is bees. That might sound funny to you, but I'm looking at our front yard out here, and there's always bees that are stopping on every flower, and they're not going to find pollen on every flower, right? Maybe the flower they're on, there's a bee that already got pollen from that flower, but they stay busy, right? And how many flowers do they land on in a day? And I'll go back to, it's really a sales thing. When I was first looking for my first job, I interviewed at Oracle. This was a long time ago, early 1990s. And I met someone senior there, and he said, okay, in Oracle, you can do the engineering side or you can do the sales side. And at that time, I wasn't sure which way I was going to go. And he said, if you choose to do the sales side, just remember, it's not about the best salespeople don't have a higher batting average than everybody else. They just have more at bats. And I've never forgotten that. And, I could already tell Oracle was already a sales juggernaut in their industry. And it's true, the most successful bees, it's not like they have a higher percentage of flowers that they land on that have pollen. It's just that they land on a lot of flowers. They work it. They work hard, and that works. And I look at it, raising money or finding borrowers, kind of the same way. Is get yourself out there, have a lot of contacts, and follow up professionally, but don't, not too much. And the money sort of comes to you, and then if depending on how much money comes to us, we might boost our lending activity slower or faster. I don't mind if our lending activity grows at a moderate pace. I'd like it to grow. I want to serve the needs that I've talked about earlier in this call, but we don't have to hit a certain size by any particular point in time. So I spend a little time on the capital raising side and a little time on the borrower side, and things kind of grow organically at the pace that they're meant to grow.
So I want to end the call with something that you told me. I remember walking into your office one day and you said, Dana, I can't talk right now because I blocked time out on my calendar and this is my time to be creative. I think it's so interesting because so many people's calendars are back to back with phone calls and meetings. What is something that you're thinking about during that time?
I would like to be able to identify some patterns and sort of underlying truths about real estate private credit that haven't been discussed yet. So for me, I would say the creative side is trying to figure out what can I say that's actually useful to somebody that hasn't already been said well by somebody else. And I would say, the number one role model in that regard would be Howard Marks from Oaktree. He's been writing memos to clients for decades, and yeah, he's covered a lot of topics. He himself has written thousands of pages, but I think that's also been what he's done, and I admire that. Is he's tried to say, what can I say about investing generally that is useful to other people that is maybe hasn't been said quite as clearly in the past. And so I would like to do that, but narrow it down to my area of focus, which is real estate private credit. Maybe that's too narrow in a way, but I can't compete with Howard Marks, so why not try to be really good at understanding one little slice of the investment universe? That's one of the things, but I really appreciate your interviewing me today, and it's fun to hear stories from our past of working together, and would like to thank you for today's interview.
You're more than welcome. If somebody wanted to reach out to you, how could they get a hold of you?
Well, probably the easiest way is our website, which is skipfinance.com. So it's SCIP, like Sage Credit Investment Partners, finance.com. And we have a contact form there, and that would be an easy way to do it.
Thanks, Jan. Nice talking with you.
Thank you, Dana.